You have a 676 credit score. Not catastrophic. Not the number that gets you laughed out of a loan application. The number that gets you approved, technically, officially, on paper approved, and then quietly charged $40,000 more than the person sitting next to you for the exact same house, the exact same car, the exact same financial product. 676 is the number the system designed to feel like almost good enough, close enough to function, far enough from excellent that every major financial transaction you make for the next decade carries a premium, a silent, compounding, never itemized on any statement surcharge that the industry collects from you automatically and calls a risk adjustment. It is not a risk adjustment. It is a revenue tier. And the distance between your tier and the one above it is not years of perfect behavior. It is specific, targeted, correctable actions, most of which take under 90 days to move the needle. Nobody told you that part. My name is Mia. I spent years inside financial services watching the credit scoring system operate as one of the most effective wealth extraction mechanisms ever built. Not by penalizing catastrophic failures, but by capturing billions of dollars annually from the enormous population of people sitting in the 650 to 720 range, close enough to participate, far enough to pay a premium for participating. Today, I am showing you exactly what a 676 score is costing you in real dollars, how the system is designed to keep you in the premium tier, and the specific actions that move the number in 2026, with the actual mechanisms, not the generic advice. The $40,000 number, where it comes from. Let me build the $40,000 in front of you, because it sounds dramatic until you see the arithmetic, and then it sounds conservative. A $300,000 30-year mortgage. The average home purchase in a mid-tier American city in 2026. At a credit score of 760 or above, the tier the industry calls prime, the current average mortgage interest rate sits at approximately 6.4%. Monthly payment, approximately $1,870. At a credit score of 676, your current tier, what the industry calls near prime, the rate moves to approximately 7.1%. Monthly payment, approximately $2,015. The difference is $145 per month. Not significant sounding until you multiply it by 360 months. $52,200 over the life of the loan. For the same house, same neighborhood, same square footage, same everything, except the 3-digit number a private corporation assigned to your borrowing history. Now the car. Average new vehicle loan in 2026, $38,000 over 60 months. At 760 and above, average rate 6.4%. Monthly payment approximately $740. At 676, average rate 11.2%. Monthly payment approximately $825. Over 60 months, the difference is $5,100. We have not touched credit card rates, personal loan rates, apartment security deposit requirements, or the insurance premiums. Yes, insurance premiums that use credit scores as a pricing input in 47 states. Add those, and the $40,000 figure is not a projection. It is a floor. This is not a penalty for being irresponsible. It is a surcharge for being in the wrong tier. And the tier you are in is not a verdict. It is a variable. How the system keeps you in the premium tier. Here is the machinery. Because the scoring system is not a neutral measurement of financial character. It is a designed product, built, maintained, and licensed for profit by 3 private corporations that are not accountable to you, not regulated in your favor, and not incentivized to make moving up the scale easy. FICO scores, the score used in 90% of major lending decisions, are calculated by the Fair Isaac Corporation. The Fair Isaac Corporation sells its scoring model to lenders. Lenders use the model to price risk. The pricing of risk generates premium interest rates. The premium interest rates generate profit. The Fair Isaac Corporation gets paid by the same institutions profiting from the tiering the score produces. Your score is not a consumer protection tool. It is a B2B product that happens to use your financial history as its raw material. Understanding that reframes everything. The score is not trying to accurately represent your financial responsibility. It is trying to accurately predict your default probability in a way that is useful to lenders. Those are different goals. And the gap between them is where millions of near-prime borrowers live. People who will almost certainly repay their debts, priced as though they might not, because the model says the probability is slightly elevated and the lender charges accordingly. The 2 biggest levers the model uses, payment history at 35% of the score, and credit utilization at 30%, are also the 2 most gameable in your favor with deliberate action. 65% of your score is controlled by 2 variables you can move intentionally. The other 35%, length of credit history, credit mix, new inquiries, is slower and less immediately actionable. Start with the 65%. What actually moves the number? In 2026, here is the specific sequence, not the generic pay your bills on time advice you have heard 100 times. The actual mechanisms in order of impact. The single highest leverage action available to most people in the 650 to 720 range is credit utilization reduction. Utilization, the percentage of available credit you are currently using, should sit below 30% for each individual card and below 30% in aggregate. Below 10% produces the highest scores. If you are carrying a $4,000 balance on a card with a $5,000 limit, your utilization on that card is 80%. That single number is suppressing your score by potentially 40 to 60 points, more than any other single factor for most near-prime borrowers. Reducing that balance to below $1,500, below 30%, can move your score visibly within 30 to 45 days of the updated balance reporting to the bureaus. You do not have to eliminate the debt. You have to move it below the utilization threshold. A balance transfer to a 0% promotional card, available to 676 scores at several institutions, can accomplish this without paying the balance down if the transfer creates lower utilization across the combined available credit. The second action is a credit limit increase request on your existing cards. A higher limit on the same balance produces lower utilization without paying a dollar. Most major issuers allow a limit increase request every 6 to 12 months via the app or online account. This takes 4 minutes and costs nothing. A card with a $4,000 balance on a limit increased from $5,000 to $8,000 moves from 80% utilization to 50%. Meaningful score impact from a single request. The third action is payment history repair for anyone carrying a missed payment in the last 24 months. A goodwill adjustment request, a written request to the creditor asking them to remove a late payment notation as a one-time courtesy for an otherwise clean account, succeeds approximately 35% of the time. Not guaranteed. Not complex. A single paragraph letter or secure message through the creditor's portal. 1 in 3 succeed. The cost of trying is 20 minutes. The score impact of a removed late payment can be 20 to 40 points. The fourth action is authorized user status. If someone in your life, a family member, a partner, has a card with a long history, low utilization, and perfect payment record, being added as an authorized user on that account imports that history to your credit file. You do not need the physical card. You do not need to use the account. The history becomes yours, and a 10-year-old account with 2% utilization appearing on your credit file moves your average account age and your utilization simultaneously. These 4 actions, utilization reduction, limit increase, goodwill adjustment, authorized user, run sequentially over 90 days and can realistically move a 676 score to the 720 to 740 range, which moves you from near prime to prime, which removes the surcharge, which recovers a meaningful portion of the $40,000 premium before the next major financial transaction you make. You are not a 676 because you are irresponsible. You are a 676 because you are operating in a scoring system designed by private corporations whose revenue depends on tiering, and nobody handed you the specific actionable mechanics of moving up while the meter was running. You are not behind. You've just been reading a map drawn by the people who want you lost. Hit subscribe, because next week I'm going inside the mortgage industry. The pre-approval theater, the rate lock manipulation, the fees that appear 3 days before closing, and showing you every extraction point between the offer letter and the keys. And I'll leave you with this: $40,000. Not lost to a crash, not lost to a scam, lost to a 3-digit number that nobody told you was negotiable. It is negotiable. Start negotiating.